Well, the U.S. dollar is finally taking a little bit of a breather, but it is coming as no comfort to gold. The price of gold is still trading down, in fact, trading at the lowest level since March of this year, even as concerns start to ratchet up. A government shutdown, perhaps even something breaking because rates are so high. Trading right now 4.6% in the United States for a 10-year. Let's bring in Bart Melek. He's Global Head of Commodity Strategy at TD. Thanks so much for being with us.
It's wonderful to be here.
So what is it? Just there's no yield on gold, so it's less attractive in this environment. What's holding it back?
Well, actually, there is always a yield on gold. Everybody can't capitalize on it, but a lot of bullion banks and large investors can. The problem with gold right now is really the cost of carry and opportunity cost. And that's really interest rates. And of course, a very strong U.S. dollar is not helping at all. So what we're seeing is, 2-year yields significantly above 500 basis points. We have a Federal Reserve that continues to give us the higher rates for longer narrative. And with oil surging, we could very well see triple-digit Brent very soon. That means we could see more inflationary pressures. And the question is going to be, will that energy hike translate into core inflation increases? There is a high probability that it will, and that basically means that what the Fed has been saying could very well translate into reality, and we will have potentially still higher rates on the policy side and higher rates along the yield curve.
So can gold do well in that environment? Because you talked about the opportunity cost of holding gold.
It's tough. It's tough to do well in this environment, and as we've seen, we're convincingly below $1,900. And what we're seeing is discretionary traders get out of their long positions and start to acquire shorts. We're seeing CTA funds, get triggered and sell off as well. And most likely, bullion holders are so-called leasing the metal, using the metal to finance with dollars. And that means more availability from inventory on the spot. And that is all serving together as downside pressure.
The price of bullion has broken below a lot of support levels. It's down below its 50, 100, and 200-day moving average. Where is support?
I think we could go another $50, $60 lower here.
But around 1,800.
Yeah, I've said, I'm on record saying we could see high 1700s. That's a possibility. Technically, I think there are some caveats to that. One, we would have to continue to see strong economic numbers and inflation to disappoint or be higher than the market expect. Something to watch tomorrow is the PCE deflators, Fed's favorite inflation measure.
We'll take the data while we can still get it.
Yes. And if we start seeing evidence that higher energy prices are, in fact, leaking into core inflation, excluding food and energy, then that could be another catalyst for more downside for gold. Now, that doesn't mean we don't like gold longer term, because we do, but it could be tricky shorter term.
So why do you like it longer term?
Well, because ultimately we do think that the U.S. economy will probably slow down quite sharply into next year. Good bet there is a recession. And I'm quite convinced that we're going to see a very aggressive move to the downside in interest rates. There will be a pivot, and it could be aggressive. The Fed has shown that it is trying to cater policy to benefit the least well-off in the country. Right now, they think it's inflation that hurts the lowest income earners most. That makes sense. High fuel, high housing prices, high food hurts the ones with least money the most.
But in some ways, those rising rates are contributing to at least what's going on in the housing market, right? Because people don't want to leave their homes.
Absolutely.
It's happening here in Canada as well through mortgage costs.
Yes, unfortunately, there is no easy way of doing it. And that's the only tool a central bank has. And central banks around the world, certainly in North American case, they're working against stimulative fiscal policies.
I'm going to take advantage of you because I know that we just brought you on to talk about gold, but you're ahead of all the commodities, the major ones. And so I got to ask you about oil because that also in some ways, to your point, feeds into your gold outlook. You think where we are right now is just a pit stop to $100?
I think $100 is very, very realistic. I think as a temporary move, this reaction over the last 24 hours is very much a reaction to Cushing inventory levels going below 22 million barrels, and that is a critical level. We continue to see Saudi Arabia being quite committed to keeping the market tight. Again, they've extended the 1 million barrel production cut into the end of the year. But as we move towards the latter part of 2023, we're going to see maintenance season, which has already started, reduce the uptake of feed or oil.
Okay.
So that could mute demand a little bit. And I'm quite convinced that strategically Saudi Arabia and OPEC Plus broadly do not want to see prices move too high. Not because they particularly care about us, but it might hurt their long-term prospects, long-term demand prospects. If you have it too high, you could substitute away into other forms. EVs, of course, are being fully developed, and they don't necessarily want to do that. So I suspect at some point they'll signal that they will provide more crude to this market. But for now, this market is tight, and we're seeing deficits.
All right.